This meeting is being recorded.
Yeah, we can start.
Right. Morning, everybody, and welcome to this session. I hope that we take away a lot of learnings from today. For me, it's an interesting topic because for some of us who work with term sheets, it's something which helps us in structuring and in trying to help clients with fundraising. So it's good to see an expert on this. The second thing which will probably of use to us is that as valuers, we are actually required to go through some of these documents to figure out what are the implications for valuation. There have been questions in our group in the past as to whether some of these are to be considered in valuation, which are the ones which have an impact on economic valuation and which don't. So I hope that in today's session, we are going to get some further inputs on what we should do when we go through term sheets, apart from what Vandana is going to tell us about. With this, I'll just hand over back to Shilpa. Over to you, Shilpa.
Good morning, friends. As you all are aware, this program has one CP hours. So I request everyone to have their video on and please attend the poll questions. Vandana, we have not selected all the questions. Some 5 poll questions we have selected. You can let me know when to run the poll. Okay, before you start the topic, I will have that poll so that you have a better idea as to how the crowd is, dealing with fundraising. Okay. It's my proud privilege to introduce today's speaker, Mrs. Vandana Tolani. She is the founder and CEO at Convanto, one of the most well-known boutique investment banks in India. She is also a venture advisor with Loyal VC, the INSEAD-led Canadian VC fund, having a core portfolio of over 160 investments in more than 35 countries, and a partner with a Silicon Valley-based venture builder. She has also been awarded as one of the top 10 women leaders in Wealth Management 2021, and her brand Convanto comes under the top 10 women entrepreneur brands along with Nika. Very, very nice profile you have, Vandana. We are privileged to hear you. Over to you.
So, first of all, I would like to thank all of you for having me here. I'm sure that some of you can get a lot of value add from today's topic, and it is good to see here everybody in morning at this hour. This is my first talk at this hour, so I took some time to get on. But thank you, Shilpa. It's great to do a talk at this hour without the phone buzzing and other stuff. So I'll quickly introduce all of you to myself. I was in Singapore and Jakarta for 15 years in investment banking, and I had my own family office fund there. This is my 7th year back in India. I did investments, then I went back to advisory. So currently I'm connected with 300 investors globally. We pick up global deals. Apart from this, I've given a 200 talks, which can be seen all over the world on YouTube. And I have been given 4 awards, which Shilpa already mentioned. So we are sector agnostic typically, and we have done 165 investments in more than 35 countries up till now. Now, the presentation that I've prepared is very, very simple in a layman's language. That I'm going to just present it to you. Shall I share my screen, Shilpa? Okay. Just a second. I'm just trying to figure out how I share just a tab. So I just need a minute for that. So is my screen visible to all of you?
Yeah, we can see the PPT.
Okay.
You can put it on slideshow mode.
Yeah. So early investment opportunities and term sheet analysis. This is what I have prepared. This is about myself. Let's see what is early stage investing. Now, early stage investing refers to investing in young businesses, startups, and other organizations, realizing their growth opportunities and value. Investing at this level usually happens in the first three stages of a company's external funding round. One is the seed funding, which is the seed capital funding provided to help you to kickstart your business essentially. And startup funding used to develop business operations, marketing, and product release. And then comes the early growth funding, where money is used to fund expansion growth and size of operations based on early results and potential. Now, typically, what I have seen is that a lot of us who have years of experience, we can do complex stuff very easily. But when it comes to simple stuff like this, that we are unable to do because we are so used to doing the complex. So this is what I have seen. So I thought I should just share this with you guys. Then comes early investing methods. In most cases, it is high net, net individuals that look in early investing opportunities, which whom we call HNIs also. However, anyone from a student to a professional can take advantage of early investing opportunities in these forms. Now, what is an angel investing? Usually an HNI or a group that invests in companies that need financial backing for capex and or an expansion or other reasons in the early growth stages, and in exchange for equity stake in the company. Now, in angel investors, they usually take above 20% equity in the company, and sometimes it goes up to 30, 40, and 50%. Now, in a venture capital, it's usually between 10 to 15%. So, like a VC fund, essentially, we recommend our clients to go through VC funds rather than angels, because then they face a lot of hassles with the angels. Of course, in our network, we do have angels as well. Private equity investing in young startups or businesses that show high growth potential in the long run. This is about venture capitalism. Unlike angel investors, these investors may not have ties with the business personally, but see opportunities for, high value, in the organization in the future. So essentially, this is what, is venture capitalism. And then comes private equity. They provide programs that, accelerators. They provide programs that give developing companies access to mentorship, investors, networks. So now we have a lot of accelerators all over the world. Especially USA is offering very good accelerators that gives end-to-end help to any startup and make it, self-sufficient business for the early stages. So at some point, we do have to connect with accelerators. The Indian accelerators, they are really not up to the mark still. And all accelerators do ask for some fees. So this is the insights of it. And then comes now let's see the I think there's some mistake with the slide. Okay. Now let's see the cons. high risk due to lack of performance related data of the startups or early businesses, hard to gauge, point of exit. I will later on show you a slide where all the exit options are there, because one gentleman had asked a lot of questions on exit. Hard to go, gauge the point of exit and time frame for growth in most cases, and it needs a very high discipline and understanding analysis before investing. Now, investors put in their hard-earned money into a startup. I have faced two cases where one founder has bought a car with investments and one has treated cancer. Now, these kind of practices are not appreciated. Essentially, it's a business that the investor is doing. It's a business that the, the startup is doing. So we have to keep business with business and not mix it with personal. Essentially, it's that. And
kindly do it in the slideshow mode, please.
If I do it in the slideshow, my screen gets too big and then I can't see my own slide.
Okay, sorry.
So sorry about that, in certain, jurisdictions, acceleration for early investing is required. However, investing in crowdfunding round is the way around it. Now, it is suggested that due to the high risk profile, very little of an investor's portfolio play money be invested. This I'm talking about accelerators and how things work in investments as well. And it is hard to determine right picks in the sea of startups, and it's even harder to get access to invest in later stage startups. So these are some of the cons that I have listed. Now, Indian startup ecosystem. Now, COVID has skyrocketed the growth of a lot of startups, but also crushed the dreams, of millions of entrepreneurs. 90% of the Indian startups failed within the first 5 years without, a unique business, model or innovation. Now, this is something that I want to highlight here. Many startup founders, they feel they know everything professionally. Like they can make the pitch deck, they can make the business plan, they can make the financial model and valuation. That is when we correct them and we tell them that these documents have to be made by a professional. It cannot be just made by anybody, because the investors expect a certain standard in the global market, and they look for certain things in the deck that has to be there. Now, let me tell you one very essential thing. Investors don't spend more than 90 seconds on a deck. So we have to keep it crisp and, short, not too much text in it, essentially just numbers. And, it is very, very essential to have a unit metric slide in the pitch deck itself, which gives a lot of number crunching to the investor so that he picks the startup from those numbers that he is seeing. Now, it is important to identify creative and impactful startups to gain, as an early investor as well. Now, later on, I'm going to show you a book that tells all about investments. Over 50% of all startups are technology enabled and AI driven. Now, let's see the sectors of startups in India. In 2020, enterprise tech was only 15%. Health tech was only 10%. Educational tech was 9%. Financial tech was 9%. Retail tech was only 7%. Consumer tech was only 6%. HR tech was 6%. Media and entertainment was 4%. Advertising and marketing was 4%. And logistics was 3%. And other creatives was only 28%. Now at term sheet, let's see what a term sheet is. A term sheet establishes the specific conditions and agreements of a venture investments between an early stage company and venture firm. The term sheet is short, usually. So before coming here, actually I wanted to show you guys a sample of term sheet. Then, I thought it's some confidential information there. Then, I opted out of it. So essentially the term sheet is short, usually less than 10 pages, and is prepared by the investor. Now, term sheets are not generally, legally binding, other than respect of confidentiality, exclusivity, if applicable to the costs and, jurisdiction of that place. And they evidence the intent of the both the parties. That is what it is. The term sheet will be one of the most important document you ever sign. Now, this document can dictate how much you will enjoy seeing your startup grow, as it outlines the key terms of your deal with these investors. Now, let me tell you one more thing. Each term sheet is very, very different from the other. There is no standard format of a term sheet. One investor will make it this way, the other will make it that way. The fund guy gives the term sheet to the startup, and then it is vetted by lawyers from both sides. And then, then we come in between as investment bankers to negotiate what needs to get where and bridge the gap and get them to the same page. Now, cons I had already shown you. There's some mix up of slides. Sorry about that. So these are the pros. Tremendous upside as an early investor if the company succeeds, and there will be exponential returns on the investment due to the increase in the company's valuation and net worth. Now, many cases where investors have walked away with multi-bagger exits on early investments, they are high reward for high risk as well. So the word high risk also comes along with it. Diversified portfolio and utilize risk profile to place such an early investments to widen possibilities while having safe investments. Now, what do we mean by diversifying the portfolio? Having more women founders you can diversify your portfolio by that. Having a lot of different kind of startups, having an international team. Essentially, investors do put in money in the team as well. Taking advantage of unprecedented technological developments, charged, entrepreneurs, and investing in the real economy, and co-investing as well. Now, let's see the nature of a term sheet. The term sheet is all about dividing the upside and risk between parties. To do so, there are a number of standard clauses that can be included. Any situation might differ, but understanding these clauses is already a good first step towards making the right decision. The key clauses of a term sheet can be grouped into 4 categories: the deal economics, total size of the round, the valuation and conversion, participation and dividends, investor rights and protection, anti-dilution rights, pro rata rights, and co-sale rights, and no shop clauses. Then there is a governance, management and control, voting and boarding, what goes on the board, and information rights, exits and liquidity, drag along rights, and redemption rights. Let's see the importance of a term sheet. Term sheets are important documents for both investors and founders for a number of different reasons, like encouraging the parties to focus on the important commercial issues, allowing the parties to address any misunderstandings or problems, allowing key legal principles to be settled, and outlining any conditions which need to be satisfied, and also to provide an outline of the process with regards to due diligence. Now, typically what we do is we provide a due diligence list to our startups way beforehand when they sign up with us, so that when they receive the term sheet, they already have the list of documents that we gave to them when they signed the mandate with us ready with them. So when they get the term sheet, they don't waste time compiling these documents for due diligence. Immediately they give it to the fund. It takes 2 weeks for due diligence and 2 weeks for fund hitting the accounts of a company. Now outline the timetable for negotiation and completion of the transaction, and set out any binding elements which have been agreed between the parties. Now, what we need to keep in mind is decide whether the document will be legally binding, partially binding, or not binding. Now, like I said, with angel investors, it's literally not binding. With VCs, it's more of legal binding. In some cases, it can be partially binding also. Since the position may not always be clear, and legal advice and clear legal drafting will eliminate most uncertainties, not to take any decisions based on current relationship with founders due to long-term prospects and time periods. Term sheets can be risky documents to use, since any ambiguity can cause uncertainty over the exact nature of the relationship between the parties. And a good term sheet will save you time, money, but a poor one will have the opposite effect. So it's very essential. What exactly are you signing? Now, these are some term sheet snapshots. I just took some small snapshots only, but essentially it's too tiny for you guys to read. Let me see if I can just do slideshow for this one, and if it helps you just have a. So the essentially it's a two-pager. And this is one example that I had put in, but it's just a snapshot. I took it from somewhere. So it's just that. And then that's about it. I'm open to take any questions. I'll just, how do I stop share? Okay, I will stop share.
Good morning, Ms. Tolani. Could you please go back to the first couple of slides, please?
Yeah, sure. Just a sec, yeah. I'll share
Also, Vandana, let me know when you want to run the poll question so that you get a hang of the crowd, like what exactly they are into with respect to fundraise.
Yeah, you can run it right away once I get back to the slide.
Yeah.
Yeah. Is my screen visible?
Yeah. The initial slides where you talked about, private equity.
Okay. Which slide number? I'll just start from the beginning.
Maybe the first slide or the second, I'm not the first slide, maybe the third slide, I guess.
Third slide. Okay, this one?
Yeah. Yeah. So when you're telling seed funding is nothing but the funding that is provided to kickstart the business. So bootstrap means actually the company is actually being managed with own funds. Is my understanding correct?
Yeah, bootstrap means self-funded. It also means that you have some existing clients and they are giving you the revenue. Say for instance, you have a cake selling company wherein you are baking cakes and selling. So you self-funded with buying the machines, you setting up all the things, and then you want to sell it further. So where is your business coming from? From people who really want to buy cakes, celebrate birthdays, anniversaries, etc. So you start bootstrapping from there. It essentially means that you have, it's all your own money. Some people already have 2-3 crores of saving and they keep using that in their startup. It's nothing to do with investors' money.
Could you also go to the next slide, please?
Yeah, sure. This one?
Yeah.
Yeah.
Where does private equity fit in?
It's a very, very large ticket side of, funding that happens. Essentially, it is anything, above 7 million, where the revenue is really splurging, it is considered, it is taken into a private equity. So essentially, if you have a $10 million raise, it is taken in a private equity fund, not in a VC. A VC will not do a 10 million.
Okay. If you can just give us the range for all the elements that were there, like seed capital, what is the range, angel, venture capital?
So see, what happens is investments happen based on the relationships you have with these investors. It doesn't, so that is one major reason that investments happen. Second is investments happen because the investor is looking at the team. And investments also happen when they see what technology the company is bringing on the table and if there is any revenue. Now, I'll give you two examples. There is a company called Forest Essentials. Then they have two other companies. One is a cloud-based company, and there's another company which they have, a beer company. Now, the founder got investments very easily in the cloud company, even when the product was not launched, because his background was very strong. So already has two huge startups which are doing successfully good. In another case, a founder got a $40 million seed funding only by showing the purchase orders. So it all depends, what is going where. Now, just to give you a small example, angel investments are only go up to 5 or 6 crore, not more than that. But there are some HNIs who want to put more also, then they are also called angel investments. VCs typically do some mid-size deals, but there are some VCs that do large size also. And PEs do very, very large size deals. You can see $100 million deal happening there, 125 million, $200 million. But it also depends on what relationships you have with these investors. What is it that exactly that you can, so no cold calling works here. You need to have an investment banker, you need to have a CFO in your company, you need to have an advisor in your company. These things help you get investments. So this is the thing.
Hi. Shall I say?
Yeah.
Hi. You mentioned about the crowdfunding. I mean, what's the scenario in India about crowdfunding?
It happens. I'll tell you, there is this Jain group of investors where they did some crowdfunding for a very nice electric taxi vehicle that has come similar to Uber. So crowdfunding happens essentially in your own circle. So say you have 10-20 friends who say, look, I'll put 10 lakhs each and let's make it big. And it's okay, we don't want equity, or, when things start moving, then you can give us 2% or something like that. Then that is essentially what goes into crowdfunding. Also depends, there are some women entrepreneurs who are struggling. They usually opt for crowdfunding. So that is a thing. So essentially, it's like your own circle or a circle of investors that you have in your group who put in small amounts, and then it gets into a crowd kind of a thing.
Super. Thanks a lot.
No problem.
We
Right,
have
so
this
carry on.
first
To carry on from that point, to carry on from that point on crowdfunding, see, for instance, there is this Inflection Point Ventures, which is a sort of app where a lot of people go and sign up and
Yeah.
they sort of raise money jointly. So do you recommend investors to go, I mean, do you recommend investors and investees to go to Inflection Point Ventures? What do you think?
Yeah, why not? See, as an entrepreneur, we need to be risk takers. So if something is clicking, just go and do it. Don't wait. Don't. There's another thing which I want to tell you over here. Many of us go into a lot of micromanaging, and then we lose out the larger picture. That we can have it later on. So I think you should be open to going to Inflection Point or any such platforms wherever you get the opportunity, the right opportunity. Of course, nobody is going to do blind moves, but I'm just saying that one should be open to anything and everything. That's what an entrepreneur needs to do. Before we go ahead, I want to show you that book. This is The Intelligent Investor. Please do read this book. It's really, really going to help you in case you're planning to make investments. You want to understand the investor's mindset, anything about investments. This book is there are some other books, if you allow me, I could show you which one, two of them. You could read them, and these books will really, help you understand a lot of deep diving thing that goes into investments. Then also, I'll just tell you, I also want to show you something, just a second. Sorry. This book, I would recommend all founders, The Power of the Subconscious Mind. Why I say so, our mind needs to be in the center when we do such things. This book has helped me a lot to succeed in business. Essentially, whatever you attract, it is attracted from the subconscious mind. So it is important that you read this book, have your mind in center. It helps you make the right decisions in business and also in the, on a personal level. This is not related to the topic, but I thought I should just show you. There are some startup books also that I wanted to show you. Now, Startup to Exit. This book also I would recommend all of you to read because it has all the steps from the beginning to exit. And this will really help you make the right decisions, right investments, set up your business in the right order, and help you get the right investments. Now, before we move further, I want to show you exit options. Just a second. I had taken them out earlier.
Who are the authors for these books, Vandana?
Sorry about it. So Startup to Exit is Shirish Nankarni. I can show it to you again. And Power of the Subconscious Mind is Joseph Murphy. And Intelligent Investor is Benjamin Graham. In any bookshop, these are available. You can also read it on your tablet. What is that online thing called? Where you can just read all the books.
Kindle?
Yeah, Kindle. Yeah. And you can even buy a hard copy. So now before we move further, I want to show you what is exit options because many people are always confused with what are exit options. Okay. Just a sec. Can you see my screen, guys?
Yes, we can.
Now, these are the exit options that I want to show you, because many people don't know what are exit options and they just hit in the air. Okay. Now, the first option is to give exit to investors through an IPO in approximate 5 years. Getting the company shares listed on stock exchange, so that with the liquidity coming through trading of shares, the investor can sell his shares anytime, partially or fully. If IPO is not possible, then the company should appoint an independent valuer of shares and find a third-party investor who will buy the shares from the original investor. The new investor should buy shares at a price which will give the required IRR, internal rate of return, to the original investor. The IRR asked is usually 20 to 25%. Now, if the second option is not possible, then the company should buy back the shares from the original investor by giving him the required IRR. And if the third option is not possible, then the founder should buy back the equity from the original founder by giving him the required RRR. If all the above doesn't happen, then the company should look for a strategic partner, one who buys a big stake in the business as a strategic investor, not as a financial investor, hence gives exit to the original investor. So kindly to have this exit options clarity, it's always essential, because many of us, we happen, we forget what are the exit options, and then we make, wrong moves essentially.
Madam, may I please?
Yeah, please.
Yeah, madam, in FEMA, there is a rule which says that you cannot mention the exact exit price. So when you are mentioning IRR at 20 or 22%, won't that mean that it would be an exact or assured price?
No, I'm just giving you an average. Like what happens is, like many founders come to us and they, what they do is they don't know how much equity to give to the investor. So they don't know what are the standard market rates. Now the standard market rates are only 10 to 15%. But they fall into wrong hands where they give the investors 30%, 40%, and then they come running back to us. So, if you have this average idea, nobody can actually dupe you. What goes on inside the cabin where the negotiations happen, nobody knows. What the founder agrees to, because he's feeling like helpless, he wants the investment, what the investor is feeling. So that is only between them both. This I'm just giving you an overview of what it is, because many of us essentially don't know, what it is, and then we just land up into different stuff. You know what I mean?
Yeah, ma'am, one more question. Whether term sheet is signed before due diligence or after due diligence?
Term sheet is signed before due diligence. Now, I'll tell you the steps. When a mandate, when we as investment bankers, we sign a mandate and we start looking for investors in our circle, it takes 2 months or before that, before we actually help a founder find an right investor. The first step is the term sheet. He will give you an offer. And then comes your due diligence, where I mentioned to you earlier that we give a list of documents to these founders, which they need to prepare it in a folder, not essentially share it with us, but that is for them to prepare it. When they receive the term sheet, they need to hand over these documents to the fund. So it's better to prepare them way beforehand. Investors do back out many times if those things are not in order. It takes essentially 2 weeks to do the due diligence. Now, if a due diligence is failing, our fund managers inform us internally. We inform the client, and then they fix up this their due diligence, whatever is going on very, very quickly, so that the investors don't back out. Then it takes 2 weeks, sorry, for the funds to hit your account, and then the process is finished.
Madam, what are the background or what is the due diligence main points which investor is looking for?
See, there's a lot of things that goes into. I cannot give you all the details, but I'll just give you an overview. Essentially, KYC documents of all the founders, your KYC documents of your company, whether it's private limited, who are the board of directors, how much salary are they taking, whose salary is how much, are your accounts in order, or is there any cash component there? So there are a lot of things that goes into your DD. Essentially, also in earlier days, now the pandemic days are there. In earlier days, they would come to your office and check everything. Now that system is over, they have other methods. You must always have a LinkedIn profile in order, enhance beautifully, have a website running. All these factors are very, very essential because investors do check all these things. What is your background, whether it's your actual background or no, whether what business you're doing is a clean business and there is no dirty money involved in it. So all these factors are there. There are lots of other documents that go into this. When we deep dive into it, that I cannot tell you, but I can just give you an overview. Basically, it's a due diligence that happens. Like when founders want to sign up with us, they also do due diligence on us. We also do on them. Investors do due diligence on everybody. So that's the thing.
So if the company has any penalties or fines due to non-compliance under Companies Act 2013, whether this all things affect or Income Tax Act, whether this all things affect?
Yeah, they affect. You need to have clean accounting, file your income tax regularly. I mean, you cannot just have like, why would the investor put in money where there is compliance issues?
No, because recently I have one client who had said that I want to sell my company, but there are so many non-compliance. I said that with non-compliance, nobody's gonna buy it. But some days later, he came back and said there are 4 people who are looking for private limited company in the same domain, and they are ready to buy also.
See, actually, many people, sorry, Sheetal, the thing is that there are lots of things happens in this industry. Now, among your circle, there could be 4 friends. They'll say, okay, no problem, we'll buy. They don't know anything about these things, due diligences, KYCs. They just want to help their friends. That is one factor. Second thing is some people just want to say something to grab attention and to just tell you, look, I'm getting this work done. So are you going to do it or no? That's another strategy that people use. So don't just fall for it unless you feel that he's actually saying or doing the right thing, he or she. It's always you'll sleep with a clear conscience if things are done in the right manner. If there is some minor issue that can be resolved, minor compliance issue that can be resolved, it's good enough. We can sort it and then show clean things and move. But if it's some major issue, then I think one should avoid always, because then whoever is buying the company will fall into a trap. So, essentially it's just that.
Okay.
Hi, ma'am. This you mentioned about the exit option. From your experience, have you come across any exits which have happened at the pre-decided IRR? By the where the promoter has bought out the investor stake?
Yeah, many. Many happen.
Okay.
All the time.
Okay.
The company was successful or the company went for a toss?
There are lots of factors. Some people, they get tired of doing business and they have reached an age point where they just want to give up everything. They have the money and everything. At some point, it's a loss-making company. At another point, there is somebody in the company that is a troublemaker. Like out of the 3 founders, one is a troublemaker. So there's a lot of things like essentially one can't predict like what goes wrong, but these are the factors. You must have seen a lot of troublemakers in certain companies. One founder is very sharif, other one is very Daku type, so you can't really deal with those people then. You have to say, okay, Jai Shri Ram and bye-bye.
Vandana ji, one more follow-on question for relating to Uttam's query.
Yeah.
So the exit strategy or the conditions or the terms are actually laid out in the term sheet, right? That's what you're telling that, okay, there is a 25% IRR, within a specific time period. Is that something that's laid out in the term sheet, or is it orally agreed?
Not all the time. Sometimes it is already there from the beginning, because the founder is very, very glued to his company and feels very secure about having those terms. 90% of the times these terms are there in the term sheet. Sometimes what is agreed upon is the things that they agree upon are on the term sheet. Some things they come at a much later stage, after 2 years, 5 years. So people don't bother putting them, and they say, okay, we'll decide later. And also, even after the term sheet, everything is there, things can change. During your investors meeting, at some other point, they say, look, let's just change these things. Or the investor might want to, just be there for, not want to exit only and just want to be there because the company is, it's like becomes his baby or something like that, So there are lots of things that goes on, which we essentially can't really predict. But some people put it right in the term sheet. Also, they put it on their pitch decks. Look, this is what I want, take it or leave it. Some don't put it. So it all depends on what is your, rapport with the investor or your investment banker, and how well your investment banker can bring you both on the same page and get the marriage happening.
One question over here. As you told that term sheets are written the IRR also and the terms of exit options. So suppose term sheets is standard rate is 10 to 15%, but the required IRR is 25%. So in term sheet, whether it is mentioned 25% or 10 to 15%, like this.
So the equity stake that an investor takes is between 10 to 15%. That is mentioned in the term sheet.
Okay.
Essentially, that is very, very important. That has to go in the term sheet. The IRR and other stuff is whatever is agreed upon, then that goes on. Either you can put it or omit it.
Okay. So if suppose it is omitted, and tomorrow there is a difference in opinion between the investor and the promoters, how the exit will happen at that time? See, suppose the first 1 or 2 options are not there, and third, fourth or fifth options is there, where the promoter is buying or buyback of the company is being done. At that time, how the investor banker will help the investor?
So essentially, both the parties have very, very strong lawyers. They don't even let us come in between. Once the fund hits the account of the founder, essentially we are out of the picture. Then what goes on in their marriage, divorce, separation is not our lookout. The deal is closed, transaction over, we walk away.
And what is the role when you arrange accelerator, basically? As an investment banker and accelerator, how you relate the relationship between them?
So what we do is, when a deck comes to us, we have these weekly investor meetings where we have UK, Singapore, Dubai investors, where we talk about the deal or show the deck and get it shortlisted. Once it is shortlisted and we get the feedback on the deck or the business plan or the other stuff, we go back to the founder, we tell them, look, you need to change your deck here. This investor is interested. And then We do take a lot of charges. I'll be open about it. We do charge for the documentation we make. We do take an upfront fees and a success fees. We don't give any free lunches essentially, but we do proper work.
Did you say that, is it a success fee or it's not a success fee?
No, we do take upfront fees. We knock it down in the success. So I'll just give you an example. If it's a $1 million raise and they have taken some upfront fees, when the money hits the founder's account and we take our success fee, we minus the upfront fee and keep the rest. Essentially, it's like that. But there is a success fee, there is a fee because we slog sometimes 3 months with a mandate. In 2 months, we bring out the term sheet. 2 weeks is for DD and 2 weeks takes for fund hitting the account. So essentially, this is the entire process that we do. Before that, if any revamping of documents is required, that is again cost effective.
One more question. As you told that you are attending the weekly investor meet. So there may be some investors who are in your circle to whom you are meeting, and there are some investors who are not in your circle. So first you try with your internal investor team, and then you go to the outside, or how it happened, or you put everything on the weekly investor meet, and then you look for what is the cheapest rate the promoter can get, or like this way.
What usually happens is that we have essentially 300 investors in our connections globally, and all are MDs of the funds that we are connected, because I have 20 years of experience in this field. I've built these relationships over 20 years. So essentially, they only introduce us to many new investors in their circle. We really don't have to hunt for new investors. So Fund A will say, I know this HNIN family office, come, I'll introduce you. So we automatically get introduced. So the weekly meetings that we have are very close circle of investors, but these weekly meetings happen with many different investors and different sectors. So if today it's consumer tech, tomorrow it will be deep tech. It's like that. And I am connected with all the MDs of the funds because I had a fund myself. So that's how it started. I had my own family.
So are your investors majorly foreign fund based? Majorly?
No, we have a lot of Indian investors. A lot of Indian investors also, but we have a lot of foreign investors also. HNIs, angels, VCs, PEs, Indian investors, all kinds of investors, strategic tie-ups, whatever you want, essentially, we have it. I think we have gone over 300, but I have not really sat with that part because there's a lot of other firefighting going on. But essentially, we have global connects as well as Indian connects. A lot many in Bangalore also. Before we used to travel a lot to Bangalore.
Madam?
Yes, sir.
Yeah, one question, madam. You would have seen a lot of valuation reports. So what is your points that valuation reports points are missing for a startup? Or investors, what factors they will mainly focus in a valuation report?
Anything that is cheap gets investors just take that. So what happens is, now founders feel their valuation has to be 100 crore, 200 crore, pata nahi kya kya, so we have to bring them down, ground them, and then explain them. Look, this is how it is. We calculated it. This is how it is done. And if you still want us to tweak the numbers, we will do it for you. If you go with this reasonable ask, there is a higher chance that you get funded. So we explain them very politely. And investors, then we have all kinds of investors. But essentially, if you ask me, like an average thing, investor wants a cheap tea that gets taken away very easily. They don't want really very high valuations, and there's a lot of essentially there is a 2 weeks of negotiations that keeps going on. I remember 3 years back, I used to go to this company because they used to say, come, we need to do the term, we need to discuss each and every clause in the term sheet. And this went on for 2 weeks. So, it's a really back and forth thing sometimes, but then I think now it has shortened because of the pandemic. I don't have to really travel much. Everything happens online, so I can finish my work fast.
How many follow-on rounds do you have, Vandana? That is, once you get an once you get a client funded, how many of them convert to the next level of funding?
We have 3 to 4 follow-on rounds.
So so the success rate will be something like
95% is the success rate through our platform. 5% we cannot guarantee because we don't know what's going to go on in the DD. We don't know how long it's going to take for the funds to hit. There were 2 cases, used cases. There was a fintech company and it received the term sheet just bang before the first, virus that had hit the first time. And that's it, everything went to stake. They got 3 term sheets from a Singapore fund, from an Indian fund, and from a Pune fund. Now, essentially, we gave him the DD documents and everything, and we said, look, you need to fix your DD. And we waited for him after the markets open, and we told them, you need to rush now because, that deal went on and on for 1 year only because the founder did not listen to me and he did not fix his problem in the DD, which I got already informed by the fund manager. So all the investors backed out. In another case, the term sheet had already gone, the DD had finished, only the funds had to hit the account and the pandemic had hit the second time. In that case, then some law had changed, anti-money laundering law had changed between UK and India that point of time. So we just got stuck for 3 months until the fund hit his account. And by the time the fund hit his account, the MD passed away with COVID. So it was a very complicated case. So that were the only 2 cases that I feel I had a hard time, but 95% of the time the case goes through our platform. 5%, these 2 factors we don't take guarantee for. We have done in total 165 investments in 35 countries in 7 years.
Right. So suppose you do a Series A, will you be typically involved in the Series B also? Or you may or may not be? You don't know.
D also. Depends if the founder starts loving me for the work and all, then I'm there all throughout Series C, D. If there is some tiff happens, then I'm not there, but most of the time I'm there. I would recommend all of you to read the testimonials on my LinkedIn page and website.
Vandana, good morning here.
Good morning.
I just wanted to know, when you go for a fundraising, you give a 2-3 year plan minimum for you to tell what the direction, what the capital required. So how do you just, did you face a scenario or how do you justify that these days when the funding is being raised every 3 months or 6 months? Is it part of the original plan that after the first round, immediately they'll be again go to the market and within 6 months or they're going to the second rounding of funding? And second question follow-up to this is, how as a IBU justify a different valuation within a period of this hardly couple of months?
Very good question, Ganeshji. So to answer your first question, essentially, when we pick up deals, we also get it vetted by investors. That is when we pick up a deal. We had a founder who gave us a hard time. We kept on explaining him. He had his valuation was only coming to 17 crores, but he was saying it's 100 crore because his CA wanted to make him happy and had calculated that for him just to take money. And we were telling him something realistic, which he didn't want to listen. Then finally we explained him, look, this is how it was done. Either if you do this way, you'll get investments. If you don't do it, then you won't get investments. So we explained him. We've sat with him for hours, and then we got him to this thing. It sometimes plays on the egos of the founders. That is what I have seen. And, hence it is really, really important that how we don't let their ego get affected and just bring them down. And we face all kinds of things all the time. So when we pick up deals, also after the investor has given us the heads up, my team of 10 members, we sit with the deal, we discuss everything about it, and then we take a call, and sometimes we just trash it.
Vandana, do you have an in-house valuation team? Like, who said to you that it is 17 crore? Is it in-house? Is it an external professional?
We have an in-house team. We are a 10 members team, or highly professional people. And, we sat with it. I did it myself, all the stuff with my team. So we have an in-house team that makes pitch deck, that makes business plans, that does the valuation, and there are certain CAs, not all, many are very, very authentic, but there are certain CAs that they want to make their client happy. So they make a certain big number of valuation, just not suited. Then we investment bankers get very into trouble and all. It's not all CAs, it's just general thing that I was saying. I'm sure there are many CAs here. All will just so that's basically the thing.
Vandana, do you also help in preparing investment documents like shareholders?
Yeah, we do, but then most of it, so I would recommend that, so the shareholders agreement, your company secretaries, these are the people that are very, very hands-on with this. We can read it for you. We can tell you that, look, maybe you could change this, that, but get it done by a professional. I mean, it's not everybody's, what you call, everybody's not skillful with that. There are certain things I have very good skills. Also, I can read through it and all, but if you ask me to prepare it, my team, we prepare term sheets, we prepare these things, but it has to be done by a proper professional CS, and a proper legal team, etc., that you should have on board with you. We do these also. Requirements come. Essentially, I'll tell you what is the thing that we do. We make term sheets for some investors also. I can tell you that as well. We have made a few in the past, but we make pitch decks. We are hands-on with that. We make business plan. We make with global standards these documents. We will give you the right financial model and valuation. We have experts in our team. But if the client has already done these documents in the right manner, we don't touch it then. Then we just move to the next step, which is the fundraising.
Vandana, I have shared in the chat box, I have shared with Shilpa also. Shilpa has shared it with you.
Oh.
There are some doubts regarding the SSA and SHA clauses, which appears, and these documents have been signed and all, but there was some confusion. If you can please address to that question.
Yeah, you had sent it to me yesterday.
Yes.
I'm not the right person to answer that question. It's essentially done by how it got done, how they reached that. I did spend 2 hours on that. The CS will help you correct this document and a lawyer. So there's a very complicated thing that you had sent across to me about the SHA. Essentially, I couldn't understand because I didn't have, a detailed background. But if you want, I can take this question offline. Whoever's asked this, Sheetal Darak has asked this.
Yep, I've asked it.
I can take it offline with you and spend 2 hours with you on a special Zoom call where you could take it forward from there.
Okay, just for my understanding, whether it's a very basic question, whether there is a difference between exit price and exit and conversion.
Yes, there is a lot of difference.
Okay, okay, fine.
Vandana, there are certain questions on chat also, that also you can take up.
Okay. Please share what are the key metrics. I will take this CR Ravi Sanjay's question. Oh, it went somewhere else. Okay, I missed that question. That what an investor. Okay, maybe I need to. Yeah. Please share what are the key metrics or expense metrics that the investor looks in a SaaS business. Now, essentially in any business, there are three factors that I want to tell you a investor looks into. One is your team. Is your team complementary? Do you have a team that complements each other? Do you have a proper marketing team, a technology team? Do you have a CFO on board, an advisor on board, an investment banker, or all these are essentials that you need to have on board with you? Is your teams, like I mentioned about that Forest Essential client, he had two very good startups, and then he had a third one with the cloud based where the product was not launched, where he got raised funds. Why? Because he was the ex-CEO of a very big company. Then he formed these two other companies, and then there was a third one. So essentially, the team matters a lot. What is it that we are bringing in this SaaS platform that you have built? Is it disruptive enough? Is there any revenue? These are some of the key metrics that, it is essential that you make a one-pager unit metrics. I have it in one of my folders. I could have shown it to you. Very, very important. If you show any key metrics, one pager with unit metrics to any investor, immediately they'll understand what you want and you can, get your investment. Make sure that you show it to somebody like an advisor on board before you show it to the investor. So that was a question by CA Ravi Sanjay. Who is CA Ravi Sanjay? Okay, I think maybe they dropped out.
Yeah, hi. So
Oh,
this is Sanjay.
hi.
Yeah.
Hi.
Yeah.
I hope
So,
I've answered your question.
Yeah, and just one correction. RV is a registered value rather than Ravi.
Oh, okay. Sorry.
Okay. We use that as an acronym before our names. You started using that.
Nice.
Right. Thanks. I mean, that clarifies. Thank you.
Okay. Now, which are the other questions?
Maybe participants can raise it, instead of speaker searching in the
Yeah,
chat.
because there are lots, and there are actually lots over here.
Actually, Vandana, I have a question. One of the term sheets what we got from an VC firm, I think we got a investor term sheet. Wherein it was mentioned that the promoter is not, cannot exit at a free cost. He has to give back his shares to the ESOP pool in case it depends upon a good cause or a bad cause what he's leaving, and depending upon the timing also, if you leave 1 year henceforth or 2 year henceforth or 3 years henceforth. So accordingly, his percentage of shareholding, whatever he had, will be put into the ESOP pool, wherein the next successor, whoever is replacing him, will get that ESOP pool.
Yeah.
So is it something like exit restrictions on the promoter? Is it common? Should we accept? Should we not accept? What is your take on that? We are the company promoter.
You can take it.
That's a common thing?
Yeah, there's no harm. There's no harm. It's a common thing. See, I'll tell you, there are a lot of common things that happen in these areas, and it's better to do it this way. It's more amicable. Otherwise, you get into very deep wars and other stuff that is just waste your time and puts you in a very. So there is this company also. I'll just tell you that where they had gotten investments through a family office. That was not done by me, and the guy really troubled them. And he troubled them so much that they came to us and they said, look, we want to replace now. And then we gave him some idea where, they politely told the investor and how they put it across the table. And now the investor is taking an exit, because what the investor did was also he took some loans through that and did some funny things inside the company that he came to know later on. So this guy was in tears when he came to us, and then we just guided him. Look, maybe you can do this way, that way. Now he's very happy. We are doing in his investments now. We have revamped his deck very beautifully. We are raising a $4 million for him. It's a food company.
So did the investor pledge his shares to some institution and get money?
Yes. So these are things that very common things that happen. So it's nothing like it's nothing really like so major. Things can be sorted out very nicely in these.
One more question. Is it very common that an investor insists on promoters inter se agreement or a founders agreement? Is it common or almost it's there? Like, what is it? Promoters agreement.
It depends from case to case. If they really insist, and then promoters also desperate to do whatever the investor wants, then they go ahead with such terms. But essentially it all depends from case to case. What internally, now if you see, there was something that happened with Zomato, so we don't know what clause he agreed to when he did the exit, and what was his thing was internal. Nobody could figure it out. So what pressure they face, what happened with Cafe Coffee Day also was incorrect. Maybe if somebody would have helped him out and he would have shared it with somebody, we could have saved one life. It is essentially we are responsible for these things, because some of the people in our system, they go just corrupt and they suggest these wrong stuff to the founders, and then they fall into this trap and misguide. So whatever work we are doing as valuers or getting the documentation done, even if the founder is not liking it, we should tell him, look, this is what it is. It's better to be safe than sorry, because if we are not forthcoming with what we are projecting ourselves to be, the authenticity factor, just because we want to pick up a work, then it gets later on, it's actually a lot of things add on to it. I would never recommend this thing. Now we see again Cafe Coffee Day is back to track. Hats off to the lady. She did a good job there. So essentially, I hope things were rectified the way beforehand. We could have saved a life in our system. So that's the thing.
So when you take on an assignment, Vandana, I mean, what is the percentage you want to see the founders holding? So for instance, let's say there is an existing situation where there's an existing investor in who be holding, let us say, a 50%. If your founders are holding just about 50% and they're looking for an additional round, would you take on that?
Yeah, why not? I mean,
okay.
Why not? If the case is doable, I'm getting my upfront fees and success fees, I would pick up. And if then my investor has given me heads up, why would I not?
Yeah. So the issue being that once you go in and get in, let's say, a round of funding of approximately 30%, the founders get diluted down. And the people who really have the biggest say in the company tend to be the earlier round of investors.
Yeah.
So is that something which you try to take care of in the term sheet to push down the rights of the earlier investors?
See, we don't give that in my investor circle. We don't let the investor have 30%. We only stick to 10 to 15%. Max comes to max, we have gone for till 20, not above that. If any investor is doing anything unreasonable, I would just go after that investor and rectify the things that he or she is doing. And we will not let the founder suffer or the investor suffer, and make sure that so essentially VCs, I would, whenever you are looking for investment, it is it's okay to go with VCs. People call them internet companies and all sorts of names, but actually they are very, very highly professional, and they come in with a lot of value add, a marketing team, a technology team, a network. They hold your back. So whenever I would recommend people to go with VCs only, avoid going with angels unless you have. So there are some angels like Sukhveer Singh is one singer that we know. That is a good HNI or an angel to go with. Or we have some others who are well known, who do things professionally. We can go with them. But if you have any just for some lala type of person who just wants to eat up your company and just trouble you, most of the people who don't know about investments. So one guy came to me 2 weeks or 3 weeks back, and he said, I am the vice president of this family office, and I have this Supreme Court lawyer connection, this politician connection, that one, and come, I'll take you to these guys, and you just have to explain them. They don't know anything about investment, and they'll put in the money. So I said, I'm not going to go to them because I don't know from where they bring their money. So I just knocked it down straight over there, and I said, please don't bring me such stuff. So I'm just telling you that even an investor, just don't go to any investor just because he has the money. Go to an investor that understands your company well, that can help you. So if you're going, if you're a food company, go to a food investor. That's what I'm saying. Don't go to a tech investor and then burn your hands in it. If you're a tech company, go to a tech investor. Don't go to a food investor. If you're a consumer company, go to these professional consumer funds who understand the consumer tech or consumer business. That's what I'm trying to explain. Just don't go anywhere, because many people don't know investments. Today, if I have the money, I'll say I'm putting 5 lakhs, 10 lakhs in your company, but I don't know anything about investments. Then why should you pick such an investor? So be picky about your investors also. That's what I'm saying.
Right. So if you look at, let's say, the founders, typically founders come maybe from the same college, but it's quite often very likely that they come from different backgrounds and are not really connected together, except for this one company in which they are together.
Yeah.
So going back to that same question which Shilpa raised earlier, where she says that let the money go into the ESOP pool. See, this founders agreement, suppose you were to get a founders agreement, how essential is that to have that founders agreement? Because you really don't know what's going to happen with the founders. I'm not looking at the Zomato case. I'm just looking at a company which is likely to start up now and has the potential to grow. How essential is this founders agreement to have in place?
Have it in place in that case. Again, like I said, it depends from case to case. If you have it, it's good for you. Whatever best things you can do to protect yourself as a founder, please don't hesitate to do it. Go ahead. Make sure you have somebody skillful in between who can give you the right direction and not misguide you. Always have an advisor on board. It's very important. somebody who's skillful in these matters, because then essentially you don't know what you're doing, and then there's a lot of bad stuff that happens. The market is like that. This market is like it's very male dominated. It's very it took me, what has taken me 7 years to get 4 awards, it could have taken me 2 years, I can tell you that. So it's that bad. So I'm just telling you that make sure that everything, whatever you can do best to protect yourself, you do, and then do. But essentially, again, what you agree with the investor, if it's your school buddy, college buddy, what is your agreement between them, then that is essentially your responsibility as well as to what you agreed upon.
What are the key terms of the founders agreement? The must-have features of a founders agreement.
It again depends, it depends what is the equity they are giving, how they are protecting themselves, who are the other founders. There's so many things that goes into a founders agreement. It depends from case to case. Kusumda Devi, it is not like, and the terms change also, but some basic terms that all the agreements have go into essentially all the agreements, like so that needs to be taken care. Always have a very good professional lawyer who can read thoroughly these agreements and guide you what you can do and what you cannot do. Now, there are many legal tech apps. Now, what happens is many startups cannot afford lawyers. That's another thing. Because they feel that the charges are too high. Now, there are a lot of legal tech apps where you get everything on one platform and very, very efficient. So I can tell
name
you
something if you can.
Yeah, this is one of the hot sector that has come in recently, legal tech. I have 3 companies I'm working with on this. I can mail you some information, and I can also mail you my PPT if you want, and any other stuff that you want.
Yes, definitely.
And then you can circle it among your group, so that you know that this is what is going on. So go for these legal tech ones, because here you will get good lawyers and very reasonably priced ones who can actually do these documentation, study, and other stuff for you. Are there any lawyers here?
Mostly chartered accountants. Few of them are company secretaries and cost accountants.
Yes, I am there.
Acha, Ganesha is Mr. Ganesha Venkat is a lawyer.
Yeah.
So guys,
So
you have
I
a
would think
lawyer.
that in a founders agreement, I think one of the key things which we'd like to see really is that the founder continues to be associated in contributing to the day-to-day efforts of the company. I think that's quite essential.
Very important. Not just wash your hands off as a investment aa gaya, chalo bhago. Ab hum chutti.
Right.
No, nothing like that. You have to just go through and through into it. Like I mentioned, one founder bought a car. That is really, really not acceptable. Treating cancer. See, I can understand what happens in cancer. We are compassionate about it, but then we have to separate personal and business always. Of course, then the investor didn't do anything to the founder because it treated cancer. Nobody would be so harsh with anybody. We are all humans, but I'm just saying that it's not acceptable. Let's be honest.
Vandana, Sanjay, one more question I had. So when we are raising funds, typically, so there are ranges, correct? You are initially in a stage where you raise $1 million, then you raise 5, and so on. So what is the cost at each round of funding one founder should look at and say that, yes, this is reasonable, or this is, I'm getting fleeced, and so on and so forth, or this is a good deal. So can you just give us ranges based on your past experience of 20 years?
See, essentially, don't give a very high equity dilution in the first round. Then your second round also, either the same investor keeps coming in, or the same group keeps coming in, or some other investor that comes in again you have to give a dilution there as well, wherein so make sure that you have done your paperwork really strong in that case, because each time you go for investment raise, there is a dilution, there is a valuation numbers that changes. Again, lots of other factors change. So have it done thoroughly by all these things by a professional. And I have seen in a second, third round also not more than 10 to 15% dilution. I can say that. In some cases, I've seen 8 also. In some cases, I've seen 17 also. So essentially, there is a Chinese investor. We had done a food company right when the pandemic had hit. That investor had taken 15%, but the investor that immediately came after that took 20 after that round got over. So it again depends. That founder was also very aggressive in the way he was doing things. And just like the way investors grill and toast founders, this founder was grilling and toasting the investors on each call. So he was so aggressive that, I had a difficult time handling him, and I told him, look, don't be aggressive and these things won't work out. So then he got back to normal. So,
yeah, so actually, essentially, I was also looking for what should a founder spend money on investment bankers, legal, and other things while raising the fund as a percentage of the fund raised.
So investment bankers, they don't take much actually. I mean, they just take a normal success fees and they walk away. So it's essential, and some of them like us, we do take upfront fees. We do take fees for documentation. So these things you need to spend on. Legal, you need to spend on. Of course, you need to give something to your advisor. If you're not paying your advisor on a monthly basis, then at least give them some equity, something that they know. So these things you have to spend on: salaries, your marketing costs. If you're developing a technology, those things you have to
So
spend.
can I say that if I'm raising 5 million, if I budget 3% cost towards raising the funds, it's reasonable, or is it less, or is it more?
Make it 5.
Okay.
Yeah.
That's the thing I was checking out for. Thank
These
you.
things you need to, if you see, I'll tell you. Also, there's another strategy that I use. If you make other people earn, and who bring the skills and value add to your system, automatically your company grows. Be large-hearted at times when you need to be, because it's essential. Like, I'll just give you one example. We have a lot of affiliate partners all over the world. We do a lot of good fee sharing with them so that the work gets done. They bring us the right people. Then we do fee sharing with the fund managers as well, who are inside the funds. So they also help us. So why do we do these things? We make them happy. They also make us happy, and then the work gets done. It's a chain, right?
Right. That's absolutely correct.
Make your chain.
Hi, Vandana.
Hi.
Generally, VCs will come up with the equity or CCPS. So there will be another chances where they will be investing through a venture debt. So what kind of interest rates they will be expecting? And apart from the debt, so is there any specific clauses like a warranty clauses or those kind of a clauses will also be exist? So what kind of interest rates they will be expecting? Generally, if you go for NBFC 20 to 21% range, it will be there.
You'll have to give between 12 to 15%.
Okay.
Unless you have negotiated it well, you can bring it down to 8.
But this kind of a venture debts, it will come only the post Series A or Series B rounds, or is it early stage also?
Early stage also, lots of venture debt funds are there. Lot
Yeah.
of debt funds are there, very good ones. They can come at early stage also, but of course there will be some warranty, etc., that you will need to give. There are lots of venture debt also funds, but founders. So you must have heard about CCDs, convertibles, as well.
Yes.
Yeah. So why do people go for convertibles? They find that safe. Now there is another thing that has come up: safe agreements.
Yeah.
So that is also a safer way to do. But I would say equity is very classy. Always go for equity. Have the classiness, but in case you are having some constraint, go for these options. That in 21 days you get debt from banks, NBFCs, essentially, and at low interest rates, you have to just give a collateral. We don't do debts. We used to do, but clients started troubling us, so we stopped doing debts. We just continue doing equity.
But what kind of other terms also the more beneficial for the investor or VCs? So generally it will be in case of equity anti-dilution or liquidation preferences will be there. In case of the venture debt, what kind of other terms where exactly we have to look into? Where I came across in terms of the warranty clause is the additional clause which has been brought into your venture debt.
Yeah, warranty clause is important. Then of course a debt is like a debt only, like a normal how you give rate of interest. If there is any security you need to give, all these things are there also. It's really not so heavy like an equity. There's no like like a long period thing and other stuff. But of course, it has it. If you need to have your documents all in order, no hanky panky in the accounts, or financial models, everything, make sure everything is in order, because this is very, very essential. In equity, later at some point you can fix things if you have not done in the DD. This one, because it happens within 30 days, so you have to be really clear with everything. And lots of venture debt companies are there. We have worked with them also. But again, equity is a better way. But if you're doing venture debt, if there is any specific thing, you can always ask me. I'm available on LinkedIn or on my email ID. Just ping me anywhere. I can just tell you. There was one infrastructure guy that reached out to me who had a fake term sheet. Now he had signed some undertaking of 56 lakhs. So he said, can you just, he requested me on LinkedIn that, can you please have a look at this? I told him it's fake, because I said no investor will take an undertaking of 56 lakhs. And then I did my own due diligence, and in a day we found out that was fake. So don't go for these fake stuff, yeah.
And Vandana, I'm told here that the Indian government presently is very suspicious about investment coming from Chinese companies or a Chinese individual, basically. So what is your take? Because, some of us could actually have a Chinese MNC or a holding company or an investor coming in. So just in case you have any, this is all a recent development which is happening. So your take on it or your views on that?
If it's a fund, then you don't need to worry. If it's a fund from Singapore and there's a Chinese MD in it, then don't worry about it. If it's an individual, then do your background checks. See, China creates a lot of problems. But the Chinese in Singapore, they are pretty good, okay to deal with. But don't essentially get any investments from China unless you have. So I'll tell you what happened day before yesterday. There's a fund called Lightbox. Now, I was telling my client something about Lightbox, but there is some Chinese fraud on Lightbox also. It's just not connected with this. Lightbox is a fund in India. So he said, He got so scared. He said, this is a fraud. I said, no, this is the LinkedIn handle. It's an Indian fund. So then it got clarified. So I'm just saying that, people are very scared of the Chinese, anything related to China, even a name can just, really shock them, like, kya aa gaya, form aa gaya, like, like that. So make sure that you've done your due diligence. If you have difficulty in doing due diligence, you can always ask me. I know what's happening in the market, kis fund ke paise khatam ho gaye, kiske aa rahe hain, who is doing what, who is investing, who's not. So thoda I have that idea. Thoda bahut I can give you reference, bahut zyada nahi, but I can help you out with any ref checks. ये तो नहीं
Actually,
होगा ना, थोड़ा
I'll
दिन
just share my personal thing. Presently, ROC Bangalore is not taking up any approvals. Like suppose I want to go and meet ROC, they say they are busy. And internally we got to know that, some of them are doing, helping the ministry to unearth whatever these Chinese investments or whatever this something which is highly confidential among themselves. So that's why in that context, I thought, of sharing. Anyone has any questions or shall we call it a day?
Yeah, we can. I have my daughter's PTM to attend.
Yeah, actually, I request Shiv Prakash to formally convey vote of thanks.
Okay. Thanks, Shilpa, for giving me an opportunity to convey vote of thanks. On behalf of Bangalore Valuers Association and ACVA RVO, we thank Vandana Tolani for accepting our invitation and presenting to us on early investment strategies and term sheet analysis. You have taken us through various stages of investments, process of fundraise, key clauses which are required in a term sheet, and then with various insights with practical examples, you have taken out the session. This is very insightful. Hope all the fellow valuers have gained new knowledge with regard to fundraise. Once again, thank you, Vandana, for a wonderful session. Thank you.
Thank you for having me here. Thank you, all of you. And it was a pleasure to see you, all of you, all ready and smiling on a Saturday, 7 o'clock in the morning. And thank you also. I could wake up early and do all this. So thank you, Shilpa. I was charged up today to wake up in the morning. Thank you so much for everything. And please feel free to connect with me on LinkedIn or through my website. I'm always there to help our fellows. And if there's any other concerns, and wish you all very safe and happy upcoming days. And may all of you be blessed with lots of happiness and good luck. And thank you for having me here. Shall I take your leave, guys?
Yes. Vandana, how about you also have some YouTube channel or something?
What happened is my YouTube channel is there, but we are still uploading a lot of videos there. But there is, if you just type on YouTube Vandana Tolani, all the videos that I have done come out. Also, if you go to the featured section of my LinkedIn, all the videos are posted there. If you can go to VCTV Latokan, there's a number, I'm investor number 38 there. All the videos are posted on their site also. So I'm all over the place essentially. You can have a look at any of the videos featured has all, and there are lots of videos there on pitch techniquing, on valuations, on all these essentials. And Latokan PCTV is the name of this thing. There all the videos are properly listed. From worldwide investors have come and spoken on VCTV. That is, I'm a regular speaker there. And then all these other platforms. Today I'm judging in Amity University in the boot camp, their startup incubation center. Yesterday I was a keynote speaker there. So all these get are there. So you can have a look. Otherwise, feel free to connect on LinkedIn. Any question, just but do give me the background where we met. Otherwise, sometimes I just get confused. So that's the thing. So hope you guys enjoyed, and my humble apologies if anything went wrong during the session or I've missed any point or not given you clarity. But please feel free to stay connected and have a happy day. Bye for now. Yeah. Bye.
Thank you.
Bye.
Thank you. Thanks, everyone.
Friends, it is just 9:10. So would you like to run a breakout room? Anyone wants to try out?
I just have one question for the entire forum. This is relating to crowdfunding. I just want to understand, see, crowdfunding, we know that we should not be representing that as equity because there is no defined share, right? Now, how do we actually account for it? And, what will happen? There are two scenarios. In one case, let us assume that there is a loss. That means we have no liability to.
So this
give
is
back
for
the money.
the forum, our own fellow buddies, fellow values.
Yeah, for our own forum, I'm just doing a loud thinking relating to crowdfunding, because I had got an instance of a filmmaker who had actually asked for money and she had actually received money. Okay, but she ended up incurring all expenditure, and the money, obviously how it works in movies is you don't get money in year one, right? You always have those rights, and those rights will, you'll have those royalties, and money will keep coming in at a later point in time, as and when the movies are telecasted. So now I just want to understand, how do we actually represent in the financial statements? So any thought process relating to that? Should we show that as a liability year on year? How do we?
What liability? What do you mean by liability? Because
Liability to pay off
crowdfunding
the.
Is it debt or
loans,
equity?
debt or equity. Yeah.
It is obviously, it is funded, and the investors have, when the investors actually, the way I had understood, or the way the explanation that was given to me is, I have no liability to pay any money back, because people who have invested anywhere between 10,000, 50,000, 1 lakh, depending on whatever, and they have no, interest in receiving this money back, but it is up to me whether to give or not to give the money.
Oh, it is something like a donation category.
That is exactly what it is. That is what is my understanding of, it is my experience of having dealt with. So, and then I had a tough time trying to figure out how do I deal with, for income tax purposes, accounting is one aspect, and income tax, because at the end of, in the year that she has actually incurred the expenditure, there was no revenue. It is actually a loss. So I had to show it as a loss. Of course, she can carry forward the loss if she files the return on time, so many things relating to that. But ultimately, I was like thinking, at what point in time will that crowdfunding, will that liability actually become an equity? So any experience, any thoughts for this entire forum?
Sanjay here. So I have been connected with the film industry long back, actually. My father used to invest. The way it works is that you got a producer and a director, correct? They had come up with the concept. Once they come up with the concept, they say that we need funding for this. So that's when the financiers come in. The financiers come in and then they give the money. There is no lien, or there's no mortgage, or there's no security which is created when they give the money. They just give the money on the face of the guys who are the producers, correct? Then these money is kind of pledged. They earn interest in the meanwhile, depending on the arrangement. The financier's money, correct? Producer's money is his equity fund, correct? The financier's money is based on the arrangement that he'll get either a return in future, or a distribution right in lieu of that, or he may get his money back with interest. So that could be the internal arrangement typically. Then what happens? And once the film is produced, correct, and it is ready, these financiers keep on pumping money as and when required. As you said, no, it is in stages, and these people keep on giving money. So that happens. So let's say it's a 3-year project. So every 6 months they pump in the money as soon as it is dried up and the production schedule is over. At which point of time, what happens is that the producer goes to these distributors and exhibitors. So distributors and exhibitors are no one else, but they're showing the movies in the theater. So for each region, there's a distributor. So there are 6 zones which are there, and then there are telecasting rights overseas also, and then there are different rights which are there. So these rights are sold. When these rights are sold, the producers realize the money, at which point of time they can So they have got the ability either to give that distribution right to the financer if he wants to take it up, or when they realize the money from these exhibitors and distributors, the money they realize, they give it back to the financer with interest. And that is how the money gets squared off as far as their books of accounts is there. And the extra money which they make is the profit at that point of time.
Do you mean to say that whenever producers produce the movie, it is actually, debt? They actually.
Money that they're getting is that you have to treat, unless they have given an undertaking, yes, I'll give you rights in lieu of this money, at which point of time you'll have to recognize that as a revenue.
Okay, this is a normal course.
This is a normal, I mean, this is how the film industry used to work. I'm talking about 20 years back when my father was associated with that. Now, if the dynamics have changed, I can't tell that.
In this case, it is actually, she just pulled in money from, went to a portal, and she said that, yeah, she expressed her interest to produce a movie, and she got money. And she told me that I have no obligation to return this money until I choose to return. And I can return, the same amount, I can return nothing or
something in return. So either it's a commitment to repay or it's a distribution right or something she must be giving away, because no one will give money just like that.
No, this crowdfunding works like that. No one.
All these are identified people, Kusuma. You get a list of who has donated. That's it.
Yeah, maybe in the portal you will get those details, but she will not have actual. She will not. For her, money simply just comes into her account. And if she wants to figure out who has contributed, she'll have to go and check it on the portal from where she has, placed
that means no agreement, no documentation, nothing.
Absolutely nothing. So for me, the whole point was, the moment I saw that, I just told that, oh, actually, you have to simply pay taxes on that because it is actually income in your hands.
Okay.
Somebody has given you money
give
for
us a
no
reference.
rhyme or reason.
We will also go and register there and get the money.
Yeah, absolutely. I can actually find that out and I can tell you. I mean, there are so many portals like that where you have to, maybe what she had done was, there was a pitch deck, where she sold a story and she said that this is what she's going to do with the money, and she ended up getting funding.
So I was actually referring to this inflection point ventures, right? Which is, see, rather than have this 25 lakh limit, which people have to invest in to be an angel investor, etc. On inflection point ventures, they are doing it by way of a crowdfunding, where you even put in 1 lakh, 2 lakh, whatever, smaller numbers than 25 lakhs, basically. So that's something which you can have a look at yourself, no? To see as to how that could potentially work. That'll give you a sense of crowdfunding in India, at least.
Yeah, but yeah. So assuming all of us in this forum are actually investing, so what are we in that fund? We are actually, shareholders. What are we? That is my question.
So you become a direct shareholder in the company which is invested into, and Inflection Point Ventures is making money off the platform. Really, that's
basically
what is
they're an intermediary.
They're
and
an intermediary.
you
That's
as an investor can decide where you want to put that money. It is not that inflection.
right, as an angel investor. So
Yeah,
for
they are
some
not
2 or 3 days, I was looking at the traffic, I mean, the web traffic which was going on between the investors. To our CFOs and companies looking at raising questions like, what is the IRR of this company, XYZ? I mean, a typical investor attitudes, no? They want to put in money, they look at the performance, but they don't realize maybe that they could end up losing the entire lot. But that's crowdfunding, no, for you.
Did you see any agreement between the crowd fund and the company, the producer? Have you gone?
Yeah, it was just a, like similar to a term sheet, where there's like, there is no obligation. Everybody understands the risk that is involved.
There is no obligation in the sense, is it an equity? See, typically the producers might understand that the equity need not be written, right?
That's correct. So
The
that's exactly
document provides for the ownership interest in the entity, or is it a debt? They see there are typically 3 scenarios. One is that it could be a debt. If you have an obligation to repay, you are saying that it was not there.
So it's neither debt nor equity, like Shilpa said.
The other way around is that the document may provide for ownership interest in the entity.
No, it was more like a donation, so to say. Because they have no, they are not insisting on receiving the money back.
Donation in the sense, a private limited company or any entity for that matter, a private company cannot take any cannot accept the donations, no?
No,
Actually,
in this case, let me also clarify. In that case, in this case, it was a producer, not a producer. She was actually a director, and she was taking the money in her individual capacity. So that is another aspect. So it was not even an incorporated entity. She was a director only based on her goodwill and based on her experience, whatever she had laid out on the platform. Money was kind of being given to her by people who wanted to invest in her. I would say not even a venture. It is just her. She had an idea and she wanted to make a reality, and she asked for money, and people who were willing to contributed. So that's something that it kind of, this crowdfunding actually baffles me, so to say.
I think there needs to be structuring to these kind of things. Until and unless there is a documentation or a structuring, whether it's a debt or an equity, I think then department will treat that as another income for the assessee. That's how it will end up.
Actually, what Mr. Abraham has stated in that inflection point, from a company secretary perspective, I feel it's totally contradicting the deposit rules. All these, we have to have an offer not more than 200 members. You cannot offer just like that to public, or else that IPO provisions will trigger. But only thing is, all the founders or the startup owners are so desperate to get money, and these, according to them, are legal. So time will say, what kind of provisions will get applicable to them, and then what kind of show cause notice will come. Because I'm sure that website will have more than 200 subscribers. Offer has gone to more than 200. So which is actually not permitted under Companies Act. But who is going to bell the cat?
And even iSafe agreements is something that I want, if anybody can actually, if BVA can take up a session on iSafe, I think that will also be very, very helpful.
That is the latest fashionable, the trending fashion, we can say, iSafe. And, I will just try to catch hold of some law firm. Law firm is the ideal for this. And any references are welcome. Because iSafe is something like, as a basic profession, we already have iSafe, so we don't know as a CA or a CS or a valuer how to treat them. And conversion terms are sometimes so hazy. The standard iSafe agreement sometimes will spell out or not spell out a conversion price. At that time, how do you consider as a debt, as an equity, or an assumed conversion price? I also have a lot of doubts. So any references, please come to me if you know any law firm who specializes in iSafe. Okay, then we'll call it a day. Thanks all. Have a happy weekend.
Thank you, everybody. Thanks, Kusum, for raising that interesting topic. Right.
Thank you so much.
I also wanted to have a workshop February. Any workshop means little extended, say 3 hours, at a stretch. So any topic? Workshop, topic for workshop. Any hints, any instances, you can directly message it to me also. Okay.
Yeah,
thanks all.
Maybe Sheetal's points, conversion, take live cases and try to understand in detail as to how these conversion works. And, maybe that will be actually very, very useful.
Okay. Thanks. Bye.
Bye-bye.
Thanks. Bye.
Bye. Bye.